Warren Buffett's Management Secrets, Proven Tools for Personal and Business Success by Mary Buffett and David Clark offers an insightful exploration into Warren Buffett's management techniques and principles. The book delves into Buffett's approach to decision-making, delegation, and recruitment, providing invaluable wisdom for managers and investors alike. With engaging anecdotes and real-life examples, it demonstrates how Buffett's strategies have played a pivotal role in his achievements as both a leader and an investor. A must-read for those interested in the realms of business and leadership. In the annals chronicling Warren Buffett's investment journey, extensive literature dissects his investment strategies. Numerous books, including Buffettology, the Buffettology Workbook, the New Buffettology, The Tao of Warren Buffett, and Warren Buffett and the Interpretation of Financial Statements, co-authored by David and me, have become international bestsellers, scrutinizing every investment decision he has ever made. However, amidst this wealth of literature, a significant gap remained: a comprehensive exploration of Warren's exceptional management prowess, how he navigates his life, businesses, and oversees Berkshire Hathaway's 233,000 employees worldwide. Beyond his investing acumen, Warren Buffett stands out as an exemplary manager, with a roster of over 88 CEOs directly or indirectly reporting to him. Few in modern business can boast of managing such a diverse and talented group of individuals across various enterprises, while consistently delivering outstanding results. Buffett's managerial achievements often overshadow his remarkable investment track record at Berkshire Hathaway, where operational annual net income skyrocketed from $18 per share in 1979 to an astonishing $4,093 per share in 2007, a compound annual growth rate of 21.39%. Interestingly, Warren's personal investment portfolio during the same period grew at a slightly lower compound annual growth rate of 19.78%, suggesting that his managerial prowess may even surpass his skills as an investor. In our endeavor to provide a comprehensive view of Warren Buffett, we present the first ever book delving deep into his management methods, what they entail, how they operate, and their potential applicability. We explore the profound influence of Dale Carnegie on Warren's life and how Carnegie's teachings shaped him into the masterful manager he is today. Structured with concise chapters for easy consumption, our audiobook elucidates Warren's straightforward yet impactful management principles. As we envision future generations embracing Warren's enlightened management philosophy to inspire and propel individuals of all ages toward their aspirations, we remain committed to disseminating all facets of Warren Buffett's legacy. Mary Buffett and David Clark, 2009. Overview: Unveiling Warren Buffett's Leadership Secrets. Once upon a time, there existed a slightly nerdy young man named Warren Buffett, who, at the tender age of 20, trembled at the thought of addressing a crowd. His life took a transformative turn when he encountered Dale Carnegie's course on public speaking, a pivotal moment that not only instilled in him the courage to speak before audiences, but also imparted invaluable lessons on making connections and inspiring others. Buffett credits his Carnegie education as the most transformative event of his life, eclipsing any formal diploma he ever received. As Warren grew adept at public speaking, he also adopted Carnegie's philosophy on interpersonal relationships. He immersed himself in Carnegie's timeless tome, How to Win Friends and Influence People, devouring its contents repeatedly, treating it as his guidebook for navigating human interactions and a cornerstone of his management ethos. Was Warren successful? Allow Liu Qi, founder and chairman of Flight Safety International, Inc., the world's leading aviation training company, to shed light on Buffett's leadership prowess. He eloquently underscores that effective management is encapsulated in the acronym LEADERSHIP: loyalty, enthusiasm, attitude, discipline, example, respect, scholarliness, honesty, integrity, and pride. Mr. Liu commends Buffett for embodying these qualities in abundance. Let's delve into Warren's leadership qualities and how he amalgamated his learnings into a winning management paradigm, propelling him not only to be the manager others sought to emulate, but also to become the second wealthiest individual globally. To facilitate comprehension, we've delineated Warren's management philosophy into 5 cohesive segments. 1. Selecting the right business. Buffett discerned early on that not all businesses are created equal. The initial stride towards success entails aligning oneself with enterprises boasting favorable economics. Whether as an owner, manager, or employee, choosing the right business sets the stage for triumph. 2. Delegating authority. Warren's distinctive approach to delegating authority catalyzed Berkshire Hathaway's transformation from a struggling textile firm into a multinational juggernaut. 3. Identifying managerial qualities. Recognizing the indispensable traits required for effective management, Warren seeks individuals embodying integrity, intelligence, and a fervent commitment to the business. 4. Inspiring the workforce. Motivating managers to unleash their full potential is paramount. Here, we explore Buffett's adeptness at motivating others, drawing from Carnegie's methodologies, which have propelled Berkshire Hathaway to staggering heights. 5. Managerial axioms for various challenges. Lastly, we dissect Buffett's managerial axioms, offering insights into navigating diverse challenges, from managing leverage to addressing ethical dilemmas. Concluding with a discussion on Warren's pearls of wisdom, we'll explore how his insights extend beyond business into the realm of life management. For success in business often parallels success in life, and Warren's wisdom holds invaluable lessons for both domains. So let's embark on this journey without delay. Warren Buffett's managerial strategies begin with selecting the optimal business to engage with. This initial step is pivotal, as aligning with the right business can determine the trajectory of one's career, differentiating between prosperity and mere toil. Moreover, it distinguishes between lucrative long-term investments and stagnant ventures. Buffett discerns that certain businesses possess inherent economic advantages capable of masking managerial deficiencies and yielding substantial returns. These are the enterprises he seeks to possess, and correspondingly, they are the ones individuals should aspire to join. Buffett delineates various traits to identify such exceptional businesses, laying the foundation for our Chapter 1, Discovering Lucrative Career Paths in Business. Finding the right business to work for can significantly impact your career trajectory. Not all businesses are created equal. Some require substantial capital investment to grow, while others flourish without such financial burdens, exemplified by Warren Buffett's approach. Understanding this disparity is key to grasping Buffett's enduring success as both an investor and business leader. Businesses with robust economic fundamentals tend to operate more efficiently, requiring minimal capital relative to their earnings. This advantage stems from various factors, such as offering timeless products or essential services, enabling them to command higher prices and enjoy superior profit margins. For instance, companies producing enduring brand name products rarely need to allocate substantial resources to research, development, or frequent equipment upgrades. This stability allows them to reinvest earnings into expansion without relying on external financing, fostering sustainable growth. Consider iconic brands like Coca-Cola, which rarely undergo significant product redesigns, allowing them to allocate funds towards acquisitions and rewarding management. In contrast, industries like automotive, where annual model changes necessitate hefty investments in design and manufacturing, face greater financial strain to stay competitive. Given the choice, working for a financially robust company with surplus cash offers more stability and advancement opportunities compared to one perpetually burning through resources. Warren Buffett advocates investing in businesses with durable competitive advantages, which ensure long-term viability, job security, and wealth creation. These super companies dominate their markets, boasting products or services ingrained in consumer consciousness. This translates to higher profitability, efficient inventory turnover, and robust cash flows, ideal for career growth and stability. Super companies typically fit into three business models: those selling unique products, offering distinctive services, or operating as low-cost providers of essential goods or services. Recognizable brands like Pepsi, Hershey, and Johnson & Johnson epitomize the first model, leveraging strong brand recognition to command premium prices and enjoy steady demand. Working for such companies offers a clear path to advancement, as they possess ample resources to reward talent, pursue acquisitions, and innovate. With solid financial foundations and consistent earnings, They provide a fertile ground for managerial excellence and career progression. Aligning with these businesses not only ensures job security, but also enhances prospects for financial success and professional fulfillment. In essence, choosing the right business to work for can significantly shape your career journey. By identifying companies with durable competitive advantages and strong financial positions, individuals can position themselves for long-term success and prosperity. Just as things go better with Coke, so too can your career flourish with the right employer. Enter the realm of companies offering unique services, a domain occupied by industry titans such as Moody's, H&R Block, American Express, ServiceMaster, and Wells Fargo. Similar to the indispensable services provided by lawyers and doctors, these companies cater to essential needs for which customers are willing to pay. However, unlike professions tied to individual practitioners, these entities are institutionally driven rather than person-specific. When contemplating tax assistance, one invariably thinks of H&R Block rather than the individual tax preparer. The economic allure of selling a distinctive service is profound. Unlike businesses focused on tangible products, these service-oriented enterprises bypass substantial expenditures on product redesigning, manufacturing infrastructure, and inventory management. Moreover, companies specializing in unique services, which establish a firm foothold in consumers' minds, often yield superior profit margins compared to their product-centric counterparts. Managing such ventures can lead to lucrative and stable careers, devoid of the financial volatility that plagues many other industries. Contrasting the operational resilience of H&R Block with that of a company like GM underscores this point. While economic downturns may dampen consumer spending, the need for tax assistance remains steadfast. Conversely, cyclical fluctuations in the automotive industry can swiftly erode profitability. Executives at H&R Block need not lose sleep over labor disputes, excessive debt, or fluctuating consumer preferences, a luxury not afforded to their counterparts at GM. In the realm of businesses focused on cost leadership in both procurement and sales, behemoths like Walmart, Costco, Nebraska Furniture Mart, Shane's Fine Jewelry, and Burlington Northern Santa Fe reign supreme. These enterprises prioritize volume over hefty profit margins, leveraging economies of scale to compensate for narrower margins. The linchpin here is to secure the lowest procurement costs, enabling these entities to undercut competitors while maintaining profitability. Reputation as the go-to destination for the best deals becomes paramount, enticing consumers to patronize these establishments. Whether it's furnishing a home, shipping goods cross-country, or seeking everyday essentials at unbeatable prices, these companies have carved out niches as the preeminent cost leaders in their respective domains. While opportunities for career advancement may be fewer in this sphere, the relentless pursuit of cost efficiency places considerable strain on management, reflecting in comparatively modest compensation packages. Nonetheless, these enterprises offer superior employment prospects compared to middling businesses lacking specialization in either unique services or cost leadership. With a clear understanding of the ideal business models to pursue, let's delve deeper into their economic underpinnings to identify those possessing enduring competitive advantages. We've devised 3 straightforward economic litmus tests to discern whether a company qualifies as one of these exceptional entities with sustainable competitive edges. Chapter 2: Identifying the Ideal Workplace. 3 quick tests for evaluating potential employers. When considering where to work, it's crucial to assess the company's economic health. One efficient method is the per-share earnings test. By examining the yearly per-share earnings figures, you can gain insights into the company's financial stability. This task is straightforward for publicly traded companies, but can be challenging for private ones. While a single year's per-share earnings figure isn't sufficient, analyzing a 10-year trend provides a clearer picture. Warren Buffett advocates for assessing per-share earnings over a decade, emphasizing consistency and an upward trajectory. For example, 1999, $1.30, 2001, $1.48, 2003, $1.60, 2005, $65, 2007, $1.95, 2008, $2.06. Consistent earnings growth signals a durable competitive advantage, making the company an attractive place to work. Such stability suggests that the company's products require minimal adaptation, and its strong economics enable strategic investments in market expansion or stock buybacks. Conversely, companies with erratic earnings like this, 1999, 8.53 cents, 2000, 6.668, 2003, -$3.35, 2005, $6.39, 2006, 6.05, 2008, 45, $2.50 thus. Display a downward trend by losses, indicating fierce industry competition prone to cyclicality. These boom and bust cycles result in instability, making such companies challenging places to build a career. Despite appearing successful during booms, their inherent economic weaknesses lead to layoffs during downturns. In summary, consistent earnings growth suggests a stable and promising work environment, while erratic earnings indicate instability and potential job insecurity. Evaluating a company's economic health is essential for making informed career decisions. The second criterion, the debt assessment, is another hallmark of an excellent employer. A company with minimal or negligible long-term debt signifies financial stability and strength. Profitable enterprises typically don't rely heavily on borrowing because their ample cash reserves enable them to finance their operations independently. Such companies tend to offer attractive long-term employment prospects, as they have the financial means to offer competitive salaries and endure economic downturns resiliently. Identifying low-debt companies is straightforward once you assess their debt relative to industry standards. Generally, a debt exceeding 5 times net earnings suggests a lack of sustainable competitive advantage. High debt levels indicate intense competition or significant leverage, both of which can constrain a company's ability to invest in growth or provide employee incentives. In such environments, servicing debt consumes excess cash, leaving little room for salary increments or expansion initiatives. Moreover, during economic downturns, these companies often resort to layoffs to mitigate costs, making them less favorable for career advancement and stability. Therefore, aligning one's career with heavily indebted companies is not advisable. Test number 3 assesses the gross margin, another crucial indicator of a company's enduring competitive advantage, which ultimately influences its desirability as an employer. This metric is derived from the company's income statement, a financial document detailing its financial performance over a specified period. By subtracting the cost of goods sold from revenue, we calculate the gross profit, which, when divided by revenue, yields the gross profit margin. For instance, if a company records $10 million in revenue and $6 million in cost of goods sold, the resulting $4 million in gross profit translates to a 40% gross profit margin. Warren Buffett's quest for companies with sustainable competitive advantages stems from his observation that such firms consistently maintain higher gross profit margins compared to their counterparts lacking in long-term economic fortitude. Illustratively, Coca-Cola boasts a consistent 60% gross profit margin, Moody's at 73%, Burlington Northern Railroad at 61%, and Wrigley's Gum at 51%. Conversely, companies like United Airlines, General Motors, U.S. Steel, and Goodyear Tire, grappling with poor long-term economics, exhibit markedly lower margins. In the technology sector, where Buffett tends to tread cautiously due to limited understanding, Microsoft flaunts a robust 79% margin, while Apple trails at 33%. These figures underscore how a durable competitive advantage empowers companies to price their offerings well above production costs, fostering sustained profitability. Without such advantages, companies resort to price competition, eroding margins, profitability, and consequently the ability to reward employees and invest in growth initiatives, particularly during economic downturns. While there are additional tests outlined in Warren Buffett and the interpretation of financial statements to ascertain a company's competitive advantage, the 3 tests delineated in this chapter offer a concise yet effective means of evaluating potential employers. Identifying a great company can pave the way for a fulfilling career path, whereas hitching one's wagon to a mediocre enterprise risks stagnation and insecurity. Though exceptional companies may occasionally falter over time, the transformation of a mediocre entity into a stellar performer is a rarity. Thus, if one finds themselves employed by a company with bleak economic prospects, it's prudent to seek alternative opportunities rather than languishing in hope of a miraculous turnaround. As Berkshire expanded and diversified under Warren's leadership, he realized the imperative of delegating authority. It wasn't merely for his own well-being, but crucial for the efficient management of his growing portfolio of businesses and the satisfaction of their managers. Warren's distinctive managerial trait lies in his remarkable readiness to delegate authority far beyond the limits most CEOs would find acceptable. Let's delve into Warren's approach to delegation and how it facilitated Berkshire's transformation from a modest regional textile manufacturer into the colossal multinational conglomerate it is today. Chapter 3: The Art of Delegating Authority. Warren Buffett, renowned for his business acumen, emphasizes the pivotal role of delegating authority in effective management. He astutely recognizes that attempting to control every aspect of a business can lead to micromanagement, resulting in neglect and inefficiency. Instead, Buffett advocates delegating responsibility to competent managers who can focus on specific tasks, ensuring thorough understanding and meticulous execution. With a portfolio spanning over 88 diverse businesses, Buffett entrusts the management of each enterprise to capable CEOs, granting them complete autonomy. Whether it's companies like Johns Manville, Benjamin Moore, or Fruit of the Loom, Buffett emphasizes the importance of empowering CEOs to make decisions independently. He famously advised the CEO of Forest River to expect minimal contact, highlighting his commitment to entrusting leadership to capable hands. Buffett's approach to delegation extends beyond assigning tasks. He delegates entire responsibilities, almost to the point of abdication. Recognizing the necessity of effective delegation, Buffett has formulated essential rules to guide successful implementation. 1. Acknowledge the uniqueness of each business culture, respecting the specialized skill sets of employees and managers. Buffett understands that his employees are experts in their fields and fosters an environment where they can excel without unnecessary interference. 2. Empower competent managers by allowing them the freedom to operate their businesses autonomously. Buffett encourages managers to take ownership of their roles, fostering a sense of pride and dedication to achieving success. 3. Prioritize integrity in managerial appointments, recognizing that honesty is paramount for the effective delegation of authority. Buffett insists on hiring individuals who are not only hardworking and intelligent, but also unwaveringly honest, safeguarding against potential mismanagement or misconduct. In essence, Buffett's principles of delegation underscore the importance of recognizing and leveraging the expertise of employees, empowering managers, and prioritizing integrity in leadership. As succinctly summarized by a Berkshire manager, sell cheap and tell the truth, encapsulating the ethos of successful delegation and business management advocated by Warren Buffett. Step 3 involves identifying the suitable manager for the task at hand. After locating or acquiring the appropriate business and acknowledging the necessity for delegation, the subsequent task is to recruit the ideal manager. Warren found that the traits of the ideal manager coincided with the managerial qualities that one should strive to develop within oneself. Let's delve into the specifics of these characteristics. In Chapter 4, Warren embarks on his quest to find the right manager, likening management changes to the tumult of marital shifts, both painful, protracted, and uncertain. Warren Buffett learned this lesson firsthand, navigating through businesses acquired at discounted rates but marred by poor management. His initial foray into Dempster Mills manufacturing epitomizes the arduous process of replacing management multiple times until the right fit is found. Was it agonizing? Undoubtedly. Time-consuming? Absolutely. Costly? Beyond measure. Yet, was it imperative? Most assuredly. The crux of making managerial changes, Warren contends, lies in discerning absolute necessity. If a business is hemorrhaging funds due to managerial ineptitude rather than inherent economic challenges, a change becomes imperative. Warren endeavors to preempt such upheavals by seeking companies with proficient management in place, insisting on annual letters from key managers delineating succession plans. This preemptive measure ensures seamless transitions in case of unforeseen events. Warren's preference leans towards internal promotions or tapping into his network of proven associates when external recruitment is unavoidable. The saga of Dempster Mills Manufacturing and the indomitable Harry Bottle encapsulates this strategy. Warren's intervention, prompted by plummeting stock values, led to Harry's appointment as CEO. Harry's strategic repricing of inventory and astute business acumen revitalized Dempster, ultimately transforming it into a lucrative investment. 2 decades later, faced with a managerial quandary at Berkshire Hathaway, Warren once again turned to the venerable Harry Bottle for salvation. The lesson resonates. Change managers judiciously, prioritize internal talent, and resort to proven expertise when necessary. Harry Bottle being the quintessential example of the latter. Chapter 5. Embracing Victory or Succumbing to Victimhood. Warren Buffett's Key to Leadership Selection. Would you rather epitomize the world's finest lover while being perceived as the worst, or embody the world's poorest lover while everyone perceives you as the best? This dilemma, posed by Warren Buffett, delves into the essence of inner and outer scorecards that define individuals. According to Buffett, true leaders march to their own tune, unswayed by external pressures, while bureaucrats conform to societal expectations. Standing firm amidst the tempest of public opinion is no easy feat. Buffett's fortune stems from his contrarian approach, buying when fear grips the market and selling when enthusiasm reigns. Free from the shackles of conformity, independent thinkers like Buffett sculpt their destiny rather than succumb to victimhood. Psychologists dissect the dichotomy of victor and victim mentalities through the lens of locus of control. Internally controlled individuals attribute outcomes to their actions, while externally oriented ones assign blame elsewhere. Buffett's father, Howard, epitomized internal control during the Great Depression, shaping Buffett's worldview. Yet, embracing internal locus of control demands grappling with personal accountability. Warren's missteps, such as his investments in Irish banks, underscore this reality. However, he swiftly learns from failure, refusing to dwell on setbacks, a hallmark of internal control. The crux lies in ownership of one's fate. Internal locus holders perceive challenges as conquerable, akin to Bill Gates, while external locus believers see themselves as victims of fate, reminiscent of Wall Street's woes. So, which path leads to prosperity and leadership prowess? Victors, with their penchant for accountability and problem-solving, excel in managerial roles. Victims ensnared in excuses and external blame falter in the face of adversity. The choice is clear: embrace victory or wallow in victimhood. The true leaders of tomorrow are forged by their ability to navigate challenges, resilience, and accountability, echoing the timeless wisdom of Warren Buffett. Chapter 6. Pursuing Passion in Work. There comes a pivotal moment when one must heed the call of their desires. Embrace a job that ignites your passion, and each morning you'll eagerly leap out of bed. To persist in roles that fail to captivate us, solely for the sake of embellishing a resume, is akin to deferring pleasure until old age. An absurd notion, as Warren Buffett aptly suggests. In our pursuit of wealth, we often find ourselves trapped in occupations that fail to resonate with our innermost selves. Yet we endure, day after day, year after year, until time slips away unnoticed. We deceive ourselves into believing that someday we'll pursue our dreams. Meanwhile, we live out our days in quiet desperation, carrying the weight of our misery home to our loved ones. This cycle of suffering in pursuit of profit typically begins early in life, driven by necessity or sometimes sheer greed. Buffett contends that sacrificing our passions for greed represents a gross mismanagement of our lives. It transforms work into drudgery, sapping our vitality and stifling our spirits. Even amid substantial earnings, our 9-to-5 existence is shrouded in discontent. In the realm of business, true success belongs to those who find joy in their work. For these individuals, monetary gain takes a back seat to their intrinsic love for their craft, whether they're programmers, salespeople, artisans, or professionals in any field. The most prosperous among us are those who derive fulfillment from their work, and this passion often translates into financial success. Buffett advocates for hiring individuals who are deeply passionate about their roles. These are the employees who take pride in their work, motivate their peers, and propel the business forward. By surrounding ourselves with those who love what they do, we enhance our chances of achieving greatness both personally and professionally. It's a simple rule. Love what you do, and in managing a business, hire those who share that love. These principles, Buffett asserts, will inevitably lead to prosperity. Chapter 7. Building a winning sales team. Warren Buffett once famously remarked, "I don't want to be on the other side of the table from the customer." This sentiment encapsulates a core principle of successful salesmanship: belief in the product. Buffett's philosophy is rooted in the understanding that genuine belief and passion for the products being sold are essential for effective salespeople. Early in his career, Buffett recognized that the most effective salespeople are those who not only believe in their products, but also exude a genuine passion for them. When a salesperson is deeply invested in and knowledgeable about their product, it resonates with customers. They understand every facet of the product, from its composition to its manufacturing process and its optimal uses. This level of understanding and enthusiasm leaves a lasting impression on customers and builds trust. Buffett extends this principle beyond salespeople to his managers. He seeks individuals who are not solely motivated by profit, but who genuinely love their work and the products or services their company offers. Many of Buffett's top managers have devoted their entire careers to their companies, driven not solely by financial gain, but by a genuine passion for what they do. For instance, consider Stan Lipsey, the long-standing publisher of the Buffalo News, who has dedicated over 3 decades to the company. Likewise, CEO Irv Blumpkin of the Nebraska Furniture Mart has been with the company since his youth, demonstrating a lifelong commitment to his work. Despite their considerable wealth, these individuals continue to show up every day because they genuinely love what they do. Their example illustrates a fundamental lesson. To build a winning sales team, it is crucial to recruit individuals who share a deep belief in and passion for the products they sell. Buffett has learned that a salesperson's passion for their product is an invaluable asset, one he can consistently rely on. Chapter 8. The Power of Obsession. In the realm of occupational dedication, a quintessential example emerges in the form of the Catholic tailor, who after years of thrift devoted his savings to embark on a pilgrimage to the Vatican. Upon his return, the parish convened a special gathering, eager for his first-hand impressions of the Pope. "Tell us," they implored, "what manner of man is he?" Without hesitation, our protagonist responded succinctly, "He's a 44 medium, Warren Buffett." Within Warren's sphere, the epitome of an ideal manager is one consumed by their business from dawn till dusk, their thoughts and dreams woven seamlessly with its operations. To Buffett, obsession is the currency of perfection. His own fervor drove him to commit the Moody Stock Manual to memory, methodically traversing its pages from A to Z. Among Buffett's revered investors was an individual of modest education, fixated on water companies to the extent that he could predict their earnings with each flush. Predictably, his wealth burgeoned through investments in water enterprises, fueled solely by obsession. In his quest for excellence, Buffett seeks out this same fervor in his employees. He posits that if he were limited to a solitary query in interviews for Berkshire positions, it would center on the candidate's degree of obsession with their vocation. His model manager, Mrs. B, epitomized this ethos, steadfastly steering the Nebraska Furniture Mart until the age of 104, her sole passion centered on her beloved store. Buffett's cadre of exemplary managers, including Geico's Tony Nicely, are characterized by an unyielding devotion to their respective enterprises. The litmus test for Buffett lies in discerning whether a prospective manager's allegiance lies with the business itself or merely its monetary fruits. Fundamentally, Buffett ascribes greater significance to an individual's early entrepreneurial spirit than their academic pedigree. In his paradigm, success is predicated not solely on intellect, but primarily on the depth of one's devotion to their craft. In Buffett's universe, it is not brilliance, but obsession that distinguishes the truly remarkable. Those who harbor an insatiable passion for their work, coupled with intellectual acumen, stand poised for extraordinary achievement in his estimation. Chapter 9. The Strength of Integrity. We firmly believe in the power of honesty, a principle we hold dear even in our roles as managers. Warren Buffett, eloquently articulates how candor not only benefits us externally, but also serves as a guiding light within our own minds. He emphasizes that individuals who are forthright about their mistakes tend to learn from them more effectively. Conversely, those who evade responsibility or shift blame for their errors are prone to deceiving themselves on larger matters. Buffett's observations, particularly in the realm of accounting, underscore the profound consequences of ethical lapses. He asserts that a willingness to manipulate one set of figures inevitably leads to a disregard for accuracy across the board. In his words, managers who consistently promise to meet targets may eventually succumb to fabricating them. Central to Buffett's philosophy, both personally and professionally, is an unwavering commitment to truthfulness. He views it as a cornerstone of character, essential for success in any endeavor. As he succinctly puts it, relying on contracts for motivation indicates a lack of integrity. In the business world, a manager whose honesty is as steadfast as the sun rising each day represents a secure investment, a guarantee of prosperity already realized. Chapter 10, Cost Management. A really good business manager doesn't wake up in the morning and say, "This is the day that I'm going to cut costs," any more than he wakes up and decides to practice breathing. Warren Buffett. Profit is the lifeblood of any business. Without profit, a business cannot survive. The essence of making a profit lies in ensuring that your costs are lower than the prices you charge for your products, the difference being your profit margin. There's no other formula. It's as simple as that. If you're not making a profit, you won't be in business for long. Conversely, substantial profits can pave the way to financial success and wealth. As business managers, we have two primary objectives: to motivate our sales teams to maximize sales at optimal prices, and to encourage our manufacturing and procurement teams to minimize costs in producing or obtaining our products. Both aspects are crucial because they jointly determine the pricing of our products. Keeping costs low is paramount, as it directly influences product pricing. Lower costs allow us to offer our products at competitive prices, enhancing their desirability and facilitating sales. An effective way to gauge a manager's cost consciousness is by observing their handling of seemingly trivial expenses. Warren Buffett underscores the significance of attention to detail in cost management. Failure to exhibit discipline in minor matters often translates to negligence in larger ones. Warren shares anecdotes of business leaders like Benjamin Rosner and Tom Murphy, exemplifying extreme diligence in cost control. Rosner's meticulous scrutiny, down to counting toilet paper sheets, and Murphy's frugality, such as forgoing painting the unseen office wall, highlight the significance of vigilance in cost management. Another facet of cost reduction pertains to personal savings. Benjamin Franklin's adage, "If you know how to spend less than you get, you have the philosopher's stone," underscores the transformative power of prudent spending. Warren Buffett's early life reflects this philosophy. His thrifty habits, like driving an old VW Beetle despite his wealth, enabled him to accumulate capital for further investment. In essence, Warren Buffett values managers who embrace cost consciousness as a fundamental principle, not just in times of crisis. Cost cutting is the swiftest and simplest method to bolster both corporate profits and personal wealth. In the pursuit of financial prosperity, simplicity in wealth accumulation is indeed a virtue. Chapter 11, Embracing Long-Term Vision. Warren Buffett's wisdom underscores the symbiotic relationship between management and investment. His journey as both a manager and an investor has illuminated the intrinsic connection between the two roles, each enriching the other. Buffett's enduring success as a long-term investor stems from his unwavering commitment to holding on to companies with exceptional economics indefinitely. This steadfast perspective has been the cornerstone of his remarkable wealth accumulation. In stark contrast, many business managers operate within a short-term framework, dictated by quarterly and annual performance metrics. Their focus on immediate results, driven by bonuses and promotions tied to short-term achievements, often eclipses any semblance of long-term planning. This myopic approach hinders proactive strategizing, leaving businesses vulnerable to future uncertainties. Buffett's managerial philosophy diverges sharply from this short-term mindset. He advocates for a shift towards proactive, long-term planning, urging managers to transcend transient fluctuations and concentrate on fortifying the business's enduring strength and viability. Embracing this perspective entails a departure from reactive management, characterized by impulsive responses to short-term exigencies, and towards a proactive stance akin to Buffett's strategic foresight. Central to Buffett's teachings is the recognition that a relentless fixation on short-term gains compromises effective capital allocation, precipitating two critical issues. Firstly, it leads to the perpetuation of investments in underperforming ventures, squandering valuable resources that could be redirected to more promising endeavors. Secondly, it engenders ill-advised forays into unfamiliar territories, often resulting in overpriced acquisitions fraught with short-sighted promises of prosperity. Buffett's transformative stewardship of Berkshire Hathaway exemplifies the efficacy of this long-term ethos. Upon acquiring the struggling textile business, Buffett swiftly realigned the company's capital allocation strategy, divesting from the declining textile sector and pivoting towards the insurance industry's more favorable long-term prospects. His prescient foresight, owned through rigorous study and astute observation of business dynamics, guided Berkshire Hathaway towards sustainable growth and prosperity. The contrast between Buffett's decisive actions and the hypothetical alternative, where Berkshire's textile operations flounder under short-sighted management, underscores the pivotal role of visionary leadership in safeguarding long-term value. Buffett's discerning eye for enduring value extends beyond financial metrics. It encompasses a holistic evaluation of managerial prowess, seeking leaders who exhibit the sagacity of prudent investors. In essence, Buffett's managerial paradigm transcends mere operational efficiency. It embodies a profound commitment to stewarding capital with prudence and foresight, perpetuating prosperity through judicious investments in people, products, and enterprises. Anchored in a steadfast long-term perspective, this approach ensures enduring resilience and sustained growth, echoing Buffett's enduring legacy as both a visionary investor and an exemplary manager. Chapter 12, Assessing Managerial Compensation. In the realm of business management, determining appropriate salaries for exceptional managers is paramount. As Warren Buffett aptly states, great managers are akin to exceptional football coaches, rare and invaluable. However, assessing managerial greatness is not a one-size-fits-all endeavor. Businesses vary in their economic prowess, with some exhibiting mediocre performance while others boast exceptional results. The key question then becomes, how do we discern the true value of a manager's performance? Warren Buffett proposes a comparative approach, evaluating a manager's achievements relative to industry benchmarks. While a business may seem to thrive, generating a robust 20% return on equity, this performance may pale in comparison to industry peers. Conversely, a manager steering a business with modest 5% returns may shine when measured against similar enterprises, indicating effective management despite challenging economic conditions. Buffett advocates for a merit-based compensation system, where bonuses reflect the manager's actual contributions rather than relying solely on the business's inherent economics. In his view, bonuses should align with the manager's ability to enhance the underlying economics of the business, emphasizing genuine value addition over superficial performance metrics. In essence, Warren Buffett's philosophy underscores the importance of discerning managerial excellence within the context of industry dynamics, ensuring that compensation reflects true performance and incentivizes continual improvement. In the fourth step, Warren recognized the pivotal importance of motivating his workforce. Understanding that effective delegation requires more than just assigning tasks, he identified motivating his managers to achieve outstanding performance as his core responsibility. With the right personnel and businesses in place, his focus shifted to inspiring his managers to reach their full potential. In this segment of the audiobook, we delve into Warren's management motivational techniques. Drawing from insights gleaned from Carnegie and others, he developed a management style that breeds success. From crafting impactful first impressions to employing praise over criticism and harnessing the power of suggestion, Warren demonstrates a remarkable ability to inspire and influence his managers. We commence by exploring his adept use of first impressions to establish a conducive work environment. Chapter 13 emphasizes the significance of making a positive first impression when meeting someone for the first time. Beryl Raff, a successful executive in the jewelry industry based in Dallas, was leading JCPenney's retail jewelry division when, in the spring of 2009, she received a call from a friend in the business. This friend asked if she would be interested in interviewing for the position of CEO of Berkshire's Helzberg Diamond Shops. Hillsborough Helzberg, a chain of 240 jewelry stores with a 90-year legacy, represented the life's work of diamond mogul Barnett Helzberg before Berkshire acquired it. Beryl had long admired Warren Buffett and his company, Berkshire Hathaway, recognizing the caliber of its personnel, the diverse portfolio of businesses, and Buffett's reputation as an exceptional CEO. The prospect of working for such a renowned organization seemed like a once-in-a-lifetime opportunity, with the chance to meet Buffett being a highlight of her career. However, what she didn't anticipate was Buffett personally picking her up at the airport in his modest car, immediately putting her at ease despite her nerves. Buffett's demeanor was lighthearted and amicable, and she found him to be both witty and charming. Following a couple of hours of discussion at his office regarding her vision for the jewelry business, Buffett treated her to a delightful lunch at his country club, provided a tour of his hometown, and ultimately extended the job offer. After deliberating for a few days, Beryl accepted the offer and has since been content in her role. She describes feeling like an integral part of Buffett's extended family, highlighting his knack for making first encounters friendly and welcoming. Buffett's approach to their initial meeting set a positive tone, fostering a sense of belonging and mutual respect. Beryl reflects on how differently her perception might have been if Buffett had not gone out of his way to make their first encounter pleasant. Had he not personally picked her up or taken her to lunch, she might have viewed him as a distant billionaire, solely concerned with profit. Such an impression could have dissuaded her from accepting the job offer altogether. The lesson gleaned from this experience is straightforward. Initiating interactions with warmth and friendliness is key to achieving favorable outcomes. Buffett's approach exemplifies the effectiveness of starting on a positive note, as it establishes rapport and fosters a conducive environment for collaboration and success. Chapter 14: The Strength of Acknowledgement. The intrinsic desire for acknowledgement runs deep within us all. Warren acknowledges this fundamental need for significance, understanding its almost innate quality. Early American psychologist and philosopher William James once articulated that the most profound principle in human nature is the yearning to be appreciated. Warren deeply resonates with this sentiment. In his studies, Warren found inspiration in the leadership of Charles Schwab, a pioneering figure in management history and former head of the United States Steel Company. Despite Schwab's admission of limited expertise in the steel industry, his managerial prowess lay in his capacity to ignite enthusiasm among his team through appreciation and encouragement. Schwab emphasized that his ability to kindle enthusiasm was his paramount asset. He believed in nurturing individuals through recognition and support rather than criticism, which he deemed detrimental to ambition. Schwab's mentor, Andrew Carnegie, exemplified this ethos by publicly praising his employees. Warren embraced Schwab's philosophy wholeheartedly, making praise a cornerstone of his managerial approach. As a leader, Warren follows Schwab's guidance religiously, showering praise on employees and managers for both minor accomplishments and major triumphs. He is their unwavering advocate, never missing an opportunity to commend them privately during Berkshire's annual gatherings and in its published reports. Warren internalized Schwab's lesson that praising individuals for small victories fosters an environment where they strive for even greater achievements. For Warren, praise is not merely an act, but a perpetually enriching gift that fuels motivation and fosters growth. Chapter 15: Harnessing the Power of Reputation. Warren grasped the pivotal lesson from Carnegie. Instilling a sterling reputation in your employees elevates their standards and merits constant commendation. The anecdote shared by Carnegie underscores this principle. A manager confronted a seasoned, once reliable worker who had fallen into apathy, tarnishing the team's productivity and craftsmanship. Presented with choices, the manager opted against dismissal or threats, choosing instead to engage the worker in a heart-to-heart conversation. Expressing genuine concern, the manager highlighted the worker's esteemed reputation, citing past accolades and contributions. This dialogue, emphasizing the worker's pivotal role and acknowledging a recent decline, prompted a transformative response. Realizing the weight of his reputation, the worker recommitted himself, revitalizing his performance and reclaiming his status as a beacon within the team. Warren fervently extols his managers as exemplars in the field. He consistently lauds their prowess in annual letters to Berkshire shareholders, during company gatherings, and in media interactions. He seizes every opportunity to reaffirm their esteemed reputation, an effortless task given their unparalleled proficiency. Advice to Bono from Warren was centered on leveraging the power of inspiration rather than guilt in rallying Americans to aid his fight against poverty in Africa. Instead of appealing to the conscience, Warren urged Bono to tap into the nation's sense of greatness and achievement. Rather than framing the issue in a way that induces guilt, Warren suggested highlighting America's capability to tackle daunting challenges, citing past triumphs like winning World War II and reaching the moon. By focusing on America's pride and its capacity for greatness, Bono could motivate the nation to action. Warren emphasized the importance of giving individuals and nations a positive reputation to uphold, as this would drive them to fulfill their potential. Conversely, invoking guilt was seen as counterproductive, as it could lead to avoidance or resentment. Ultimately, Warren's approach was grounded in the belief that appealing to the inherent greatness of others is the most effective way to inspire action and foster success, not only for Bono, but for anyone seeking to motivate and inspire others. Chapter 16, The Pitfalls of Criticism. Utilizing criticism as a motivational tool proves futile as it triggers defensiveness, wounds pride, diminishes importance, and stirs resentment. Warren came to understand the universal aversion to unsolicited criticism. It festers resentment, driving young adults away from parental homes and often contributing to the demise of marriages. Despite this, many still commit the error of dispensing unsolicited criticism, particularly in professional settings. Warren's early lessons taught him that criticism fails to inspire his managers. It lacks the capacity for sustainable change and corrodes productive working relationships. Rather than criticize mistakes, Warren opts to comprehend the underlying issues and the reasons behind misjudgments. He empathizes with his managers, striving to see things from their perspective. He acknowledges that intelligent risk-taking entails occasional errors and grants his managers the leeway to learn from such mistakes. A glimpse into Warren's approach in action reveals David Sokol, one of his top managers overseeing Berkshire's Mid-American Energy Company. David once incurred a $360 million loss on a failed zinc project. Expecting termination or severe criticism from Warren, David was surprised when Warren simply acknowledged the mistake, stating that errors are inevitable. Warren shared his own past blunders, advising David to learn from the experience without dwelling on it. David's admiration for Warren soared, leading him to avoid similar errors and excel in his role, transforming Berkshire's energy operations into industry-leading profitability. Had Warren resorted to berating, mocking, or criticizing David's blunder, it would likely have fueled resentment and hindered David's motivation to continue building the successful enterprise it is. Address individuals by name when offering praise, but critique broader categories when necessary. Warren understands the power of both praise and criticism in motivating others. When wielded adeptly, they can foster productivity and success, but misapplied, they risk demoralization and failure. Warren believes mastering the art of constructive feedback is paramount for effective management. By recognizing the importance of personalized acknowledgement, a manager can inspire greatness in any endeavor, whether it's enhancing team efficiency or guiding personal growth. Warren's strategy is simple yet profound. Commend individuals by name and address issues by category. Praise fuels our motivation, validating our efforts and propelling us toward excellence. Conversely, criticism can deflate our spirits, signaling missteps and detours from our goals. Yet when criticism becomes unavoidable, Warren follows Carnegie's advice, first showering individuals with praise to foster trust and receptivity. By embracing this approach, Warren not only uplifts his team, but also navigates delicate situations with finesse. Whether pacifying shareholders or nurturing familial relationships, Warren's method remains consistent. Praise individuals for their accomplishments before addressing areas for improvement. This strategy, proven effective in Warren's hands, holds the potential to empower anyone willing to harness the power of positive reinforcement and thoughtful critique. Chapter 17: The Art of Persuasion. In the pursuit of winning arguments, one might discover that victory lies in strategic concessions. Early on, Warren grasped a fundamental truth. Winning an argument isn't always about proving oneself right from the outset. He realized that openly correcting someone could bruise their ego, potentially leading to resentment. Drawing wisdom from Carnegie, Warren understood that rather than opposing someone outright, it was wiser to align with their perspective to establish trust. By doing so, he could then gently introduce his own ideas. Embracing this philosophy, Warren became renowned for his aversion to conflict and his adeptness at navigating disagreements. A hallmark of Warren's approach is his willingness to listen attentively and respect divergent viewpoints, even when they clash with his own. Yet, it's his knack for finding common ground that allows others to lower their defenses and consider his stance. He recognizes that gaining someone's ear is the crucial first step toward winning any argument. Consider a scenario. Suppose a young Warren, working as a securities salesman, encounters a potential client favoring Philip Morris over Geico stock. Rather than engaging in a debate, Warren would affirm the merits of Philip Morris as a sound investment, diffusing tension and paving the way for a discussion about the virtues of Geico. The influence of Benjamin Franklin. The wisdom of Benjamin Franklin, a key figure in American history, has profoundly shaped the philosophies of both Warren and his partner, Charlie Munger. At Berkshire shareholder meetings and in annual reports, they often acknowledge Franklin's impact on their business and personal ethos. Thus, it's unsurprising that Franklin's strategy of eschewing arguments and honoring differing opinions resonated with Warren. A passage from Franklin's autobiography particularly resonated with Warren. I made it a rule to forbear all direct contradictions to the sentiments of others. When another asserted something that I thought an error, I denied myself the pleasure of contradicting him abruptly. Franklin's approach emphasized humility and tact in expressing one's opinions, ultimately fostering smoother interactions and greater receptivity. Warren recognized the efficacy of this approach in persuading others to embrace his ideas, a skill invaluable in both amassing fortunes and shaping nations. Chapter 18: Understanding and Addressing Others' Needs. To effectively persuade others to take action, it's essential to shift focus from our own desires to theirs. Warren has gleaned a profound insight. Success as a manager and business owner hinges on discerning and addressing the wants and needs of others. An early influence on Warren's approach was Henry Ford, who emphasized the importance of grasping the other person's perspective. Warren has seamlessly integrated this principle into both his personal and professional spheres. Instead of resorting to nagging or criticism when encouraging change in his children, he appeals to their desires. For instance, when motivating them to adopt healthier habits, he incentivizes weight loss with monetary rewards, understanding their adolescent craving for spending money. In business dealings, such as acquiring privately held companies for Berkshire Hathaway, Warren adeptly taps into the owner's motivations. While recognizing their desire for financial gain, he also acknowledges their concern for preserving the legacy and well-being of their employees. This approach has enabled Warren to secure numerous acquisitions, even when facing rival offers with higher monetary figures. Take, for example, the case of Rose Blumpkin, owner of Nebraska Furniture Mart, who was offered a substantial sum by a foreign conglomerate. Despite her financial aspirations, Rose was reluctant to relinquish control of her beloved business. Warren, recognizing her attachment, offered a solution that addressed her needs: partial ownership retention and continued management authority. This not only secured a valuable acquisition for Warren, but also retained the expertise of Rose and her team. Similarly, when negotiating with Liu Qi, founder of Flight Safety International, Warren recognized the significance of preserving Qi's passion for his work. By offering a lucrative deal coupled with the opportunity to remain involved in the company's operations, Warren ensured a mutually beneficial outcome. Ultimately, Warren's ability to empathize and address the needs of others has yielded remarkable results. Through thoughtful consideration of their perspectives and desires, he has secured valuable acquisitions and fostered enduring partnerships, all while maintaining a winning smile. Chapter 19: Fostering Innovation Through Encouragement. Inspiring others to discover the right idea themselves holds far more motivational power than simply providing the answer. Warren Buffett, renowned for his leadership style, refrains from dictating tasks to his team members. Instead, he empowers them to set their own objectives and benchmarks. Surprisingly, they often aim higher than he would have envisioned. Warren's taciturn approach leads his managers to infer high expectations, which ultimately propel their performance. Issuing commands tends to evoke resistance, while ideas conceived independently are embraced with zeal and determination. Consider the anecdote Andrew Carnegie often recounted about an auto dealership sales manager who, after numerous failed attempts at motivation, elicited exceptional results by inviting his team to articulate their expectations of him. Their subsequent commitment to self-imposed standards led to unprecedented sales achievements. This simple yet effective approach is readily applicable in various contexts. Instead of outright prohibitions, outlining the adverse consequences can dissuade undesirable behavior. For instance, cautioning against swimming in a lake due to lurking crocodiles instills a vivid deterrent. Similarly, highlighting the positive outcomes of an action fosters intrinsic motivation. For example, expressing the joy derived from increased sales productivity and its potential for larger bonuses resonates with workers' aspirations. Parenting, too, can benefit from this method. At the onset of the school year, engaging children in a dialogue about mutual expectations fosters a sense of responsibility and cooperation. By refraining from direct commands and employing inquiries, parents can nurture independent thinking and self-discipline in their children. Warren Buffett's management philosophy underscores the effectiveness of questioning over commanding. Recognizing the aversion to authoritarian directives, he leverages inquiries to guide his managers subtly. By framing suggestions as questions, employees are not only receptive, but also inclined to contribute their own insights and solutions. This collaborative approach cultivates a sense of ownership and initiative within the team. In practice, converting direct orders into suggestive queries can yield remarkable results. By inviting employees to ponder solutions and offering gentle nudges, leaders can harness the innate drive for autonomy and problem solving. Warren Buffett's penchant for inquiry over instruction exemplifies the transformative potential of this approach, fostering a culture of innovation and accountability within his organization. Chapter 20? Embracing mistakes. Acknowledging is paramount. Warren advocates for swift and unequivocal admission of errors. He believes transparency in admitting faults prevents any perception of deceit or lack of integrity. Such honesty fosters trust, a vital currency in any relationship. Nobody appreciates perpetual correctness, nor can they tolerate the refusal to acknowledge errors. Failure to admit mistakes breeds suspicion. It erodes respect and trust. Refusal to acknowledge errors can contaminate the workplace, breeding a culture of distrust among employees. Warren's approach is refreshingly different. He readily owns up to his mistakes, openly discussing them with his team and shareholders. His candidness has endeared him to them. Even amidst significant financial losses, like the missteps in Irish banks and ConocoPhillips investments, Warren doesn't shy away from accountability. He doesn't deflect blame or downplay the magnitude of his errors. Instead, he forthrightly admits his misjudgments, attributing them solely to himself. Warren's transparency not only earns the respect and trust of his stakeholders, but also shields him from the political repercussions that have plagued many leaders throughout history. The concluding sections of this audiobook delve into managerial traps, obstacles, and chances for growth. They encapsulate Warren's essential principles on the perils of excessive borrowing. From staff veering into unlawful territory to promising ideas losing direction, from errors in judgment to navigating around sycophants, missing opportunities, and foreseeing future challenges, each experience offers valuable lessons. These insights are earned through the school of hard knocks. Reflect on them diligently, for they serve not only to steer you clear of managerial pitfalls, but also to guide your way out of them. Chapter 21: Navigating the Perils of Borrowed Capital. In the realm of business, the path is fraught with obstacles. A strategy reliant on sidestepping every challenge is a blueprint for disaster. Warren Buffett aptly warns that businesses heavily dependent on borrowing are essentially gambling, banking on an unimpeded journey through future economic uncertainties. Even the most impeccably managed enterprises cannot indefinitely evade hurdles, especially if burdened with significant leverage. Banks reign supreme in the realm of leverage, operating on borrowed funds that they then lend out. However, the precarious nature of this practice becomes apparent when short-term creditors demand repayment, leaving banks scrambling to cover their commitments. Economic fluctuations present both opportunities and perils. While they can be exploited with sufficient liquidity, excessive debt can transform them into existential threats. The allure of leverage lies in its potential to exponentially amplify business performance. Consider a scenario where a company typically earns $6 million annually. An enticing opportunity arises requiring a $100 million investment, promising $15 million in returns per annum. Despite lacking the necessary capital, a friendly Wall Street bank offers a loan charging $10 million in interest annually. After servicing the debt, the net profit from the new venture amounts to $5 million, elevating the company's total earnings to $11 million. Succumbing to this temptation often results in substantial bonuses for adept managers. In the realm of investment banking, leveraging is taken to extremes, with massive short-term borrowings generating colossal profits. However, the peril becomes evident during economic downturns when plummeting revenues render debt servicing unfeasible. Consequently, companies risk depletion of their assets or even bankruptcy, with management bearing the brunt of consequences. Warren Buffett's prudent approach emphasizes the significance of a company's resilience during economic upheavals, drawing insights from its performance during past crises. He underscores the importance of maintaining a long-term perspective and scrutinizing debt levels, recognizing that excessive leverage can jeopardize even the most venerable businesses. Berkshire Hathaway, under Buffett's stewardship, eschews debt, opting to accumulate cash reserves instead. This conservative approach not only fosters financial stability, but also equips the company to capitalize on market downturns. In stark contrast, the proliferation of debt-driven strategies in recent years has led to the downfall of many businesses during economic downturns, underscoring the enduring wisdom of traditional management practices. In the tumultuous landscape of finance, seasoned veterans like Warren Buffett advocate for prudence and restraint, cautioning against the allure of quick gains through leveraging. As the adage goes, sometimes the old dogs truly do possess the most valuable tricks. Chapter 22 poses the question, do good ideas always yield positive outcomes? Warren Buffett, echoing his mentor Benjamin Graham, warns of the peril of good ideas, suggesting that they can lead to more trouble than bad ones. While managers swiftly discard bad ideas, good ones are pursued, potentially evolving into institutions. The genesis of subprime mortgages exemplifies this notion. Initially conceived to facilitate home purchases for individuals with limited credit and to generate profits for mortgage brokers, the concept burgeoned. However, its unchecked proliferation eventually triggered a catastrophic recession when individuals defaulted on payments. A similar narrative unfolded with insurance behemoth AIG, which initially thrived by insuring investment-grade corporate bonds. Buoyed by success, AIG ventured into insuring pools of subprime mortgages without comprehensively assessing the associated risks. When the recession struck and subprime mortgages defaulted en masse, AIG found itself mired in a crisis. The plummeting value of insured bonds necessitated substantial collateral, ultimately jeopardizing the stability of global financial institutions. To avert a cataclysmic economic collapse, the U.S. Treasury intervened with an $85 billion bailout. Thus, what began as a commendable idea of insuring corporate debt metamorphosed into a calamitous venture for AIG and the global economy. Buffett's adage rings true. The repercussions of good ideas can far outweigh those of bad ones. Chapter 23. Managing Legal Infractions Among Employees. Warren Buffett once advised the managers of his companies, in the aftermath of the Salomon Brothers bond trading scandal, to focus on the heart of the matter, rather than skirting its periphery. Salomon Brothers, a renowned Wall Street investment bank, celebrated for its bond trading expertise, found itself embroiled in controversy during the late 1980s. Warren had invested $700 million in the company's preferred stock, only to face a crisis when, in 1991, several of Salomon's bond traders violated the U.S. Treasury's bidding regulations for Treasury bonds. These traders were caught attempting to manipulate bids to secure a larger portion of the new issue of Treasury bonds than allowed by the U.S. Treasury. Despite the discovery of these illegal actions, Salomon's management initially failed to disclose the misconduct to the Securities and Exchange Commission or the U.S. Treasury. Consequently, the Treasury contemplated banning Salomon from trading in treasuries, a move that would have been detrimental to both the company and Warren's investment. At the behest of Salomon's board of directors, Warren assumed the role of chairman and swiftly enacted reforms, ousting the implicated CEO and top management. He also initiated a transparent approach with the U.S. Treasury, granting investigators unrestricted access to Salomon's records. Although Salomon incurred a substantial $290 million fine, it retained its trading privileges in treasuries, safeguarding its viability. Warren imparted a crucial lesson to his managers. While pursuing financial gains aggressively, it's imperative to operate within legal boundaries. When managers flout laws for short-term profits, they jeopardize their entire enterprise with a single misstep. In Salomon's case, a group of bond traders imperiled the company's existence for a marginal advantage in the government bond market. As managers, it's our responsibility to vigilantly monitor our employees to prevent reckless actions aimed at advancing their careers at the expense of the organization. Upon uncovering any illegal activity, the immediate course of action should be to notify the authorities. Failing to do so makes one complicit in the wrongdoing, constituting a crime in itself. It's a harsh lesson best learned through cautionary tales rather than personal experience. Chapter 24. Embracing Imperfection. Mistakes are inevitable companions on the journey of life. I've made my fair share, and undoubtedly I'll make more. Such is the nature of the game. The key lies in ensuring that the triumphs outweigh the errors, as wisely noted by Warren Buffett. Nobody, not even Warren, is flawless. Mistakes are woven into the fabric of existence, an inescapable part of the landscape. The crucial reminder is that our victories must tip the scales heavier than our blunders. Should the equation invert, trouble brews. Warren Buffett's own missteps are testament to this reality. He's erred by overpaying for businesses like ConocoPhillips and backing sinking ventures such as the erstwhile U.S. Air's blue chip stamps. Opportunities missed also litter his path. Initially dismissing Capital Cities Broadcasting is but one example. Mistakes even colored his managerial decisions, as evidenced by ill-suited appointments and mishandled operations. Yet, despite these missteps, Warren stands as a paragon of handling mistakes. He acknowledges them, learns from them, but refuses to dwell. Those who linger on their errors squander precious time and energy that could otherwise be invested in forging new paths to prosperity and happiness. Mistakes belong in the past, serving solely as lessons to guide future endeavors. After all, as Warren sagely points out, the real wealth lies ahead, waiting to be seized. Chapter 25. The Dangers of Sycophancy. Are sycophants assets or liabilities? One thing is certain, when a CEO is enthusiastic about a foolish acquisition, both internal staff and outside advisors will conjure up projections to justify their stance. Only in fairy tales or tales of naked emperors is such blindness celebrated, as Warren Buffett quipped. Leaders crave admiration, and in their quest for it, they surround themselves with yes men. These individuals earn their keep by showering the boss with praise and endorsing questionable ideas, regardless of their truthfulness. Why don't they speak the truth? Because that's not their role. Their job is to echo the boss's sentiments, and for that, they are handsomely rewarded. Every organization harbors sycophants lurking in the shadows, ingratiating themselves with the boss and distorting reality. Even hiring an advisor doesn't guarantee independent counsel. Often, their role morphs into endorsing the boss's initial inclinations. Advisors who dissent too often find themselves replaced swiftly. Most leaders prefer not to keep dissenters around. But what's the harm in surrounding oneself with yes men? Nothing, until the inevitable disaster strikes, unforeseen by the blinded leader and their compliant entourage. Wall Street is replete with examples of CEOs led astray by their yes men, believing they could tame the risks of derivatives until reality crashed down upon them. Warren Buffett's solution is to keep his inner circle small. He famously quips that his idea of a group decision is consulting the mirror. Additionally, he values the contrarian input of Berkshire's vice chairman, Charlie Munger, who says no far more often than yes. Charlie serves as Warren's no man, preventing him from veering into disaster on multiple occasions. While Charlie's refusals may not win him popularity contests, they have undoubtedly saved Warren from catastrophic misstep. Chapter 26. Learning from Missed Opportunities. Warren Buffett once remarked, "Since mistakes of omission don't appear in financial statements, most people don't pay attention to them. Indeed, the oversight of missed opportunities often remains unnoticed. Even the most adept managers occasionally falter, overlooking potential ventures that could have significantly benefited their endeavors." In the realm of investing and overseeing Berkshire, Warren Buffett candidly acknowledges his fair share of missed chances. He reflects on instances like not seizing the early opportunities presented by Walmart and Walgreens. When faced with a missed opportunity, Buffett adopts a reflective stance. He delves into why certain prospects eluded his attention, or why, despite recognizing them, he refrained from action. This introspection serves as a beacon for enlightenment, aiming to prevent the repetition of similar oversights in the future. Buffett categorizes missed opportunities into two fundamental types: those beyond our scope of awareness and those we consciously overlooked. The former can be addressed by broadening our search horizon. There exists a plethora of avenues, such as business brokers and investment bankers, eager to unveil potential opportunities. As for the latter category, wherein opportunities were within sight but left unexploited, the primary culprit often lies in a misjudgment of risk. These are opportunities we desired to pursue, but deemed excessively risky in error. Mistakes of omission stemming from misjudgments of risk are comprehensible, born out of the information available at the time of decision-making. Buffett's reliance on the managers of his subsidiary companies for major decisions exemplifies his trust in their expertise. However, lapses in seizing opportunities due to oversight reflect on our managerial and organizational abilities. A proficient manager perpetually scans the landscape for opportunities and establishes the requisite infrastructure to facilitate timely action. Emulating Buffett's approach, the best managers scrutinize their past oversights, probing into the underlying reasons. Armed with insights gleaned from these evaluations, they position themselves to grasp the elusive opportunities that once slipped through their grasp. Chapter 27. Embrace the wisdom of others. Isaac Newton once remarked, "I've seen a little more of the world because I stood on the shoulders of giants." There's immense value in leaning on the tried and true. Warren Buffett, echoing this sentiment, emphasized the fallacy of believing that originality alone propels success. Instead, he advocates for embracing proven ideas, minimizing the risk of costly mistakes. Great ideas, Buffett asserts, are not necessarily novel. Rather, they are those that have stood the test of time. They stem from observing successful businesses and learning from their strategies, as well as analyzing failures to understand pitfalls to avoid. In the realm of creativity, Miles Davis famously said, "Lesser artists borrow, great artists steal." Similarly, in business management, the practice of adopting successful strategies from competitors is not only permissible, but beneficial. By studying what works and what doesn't in the market, one can glean invaluable insights. Consider the story of Rose Blumpkin, who brought the concept of discount pricing from Russia to America, revolutionizing retail at her Nebraska furniture mart. Her success was not in inventing something new, but in recognizing a proven strategy and implementing it effectively. Similarly, Jack Ringwald's disciplined approach to underwriting at National Indemnity proved immensely profitable. His mantra, "There is no such thing as a bad risk, only bad rates," guided Warren Buffett's acquisition strategy. propelling Berkshire Hathaway's growth in the insurance sector. The lesson is clear. Success in business doesn't require reinventing the wheel. Instead, it involves recognizing and implementing time-tested strategies. You don't need to scale Mount Everest to know its height, nor do you need to be a genius to identify effective management or well-run businesses. By learning from the experiences of others, as Buffett has exemplified, success becomes attainable for all. Chapter 28, Ascend the Social Ladder. Warren Buffett advises us to elevate our circle. Surround yourself with individuals who inspire you to be better. Choose associates whose conduct surpasses your own, and naturally you'll gravitate toward improvement. Warren emphasizes that our companions shape our personal trajectories. Socializing with those of low character will inevitably pull us down, while engaging with intelligent, educated individuals will lift us up. During his youth, Warren frequented the racetrack, honing his skill in probability assessment. Instead of succumbing to a life of gambling, he leveraged this knowledge in academia and beyond. Guided by older, wiser mentors, Warren ventured into the realm of finance and investing, steadily advancing upward. In his early years managing an investment partnership, Warren forged relationships with Omaha's business elite. Notably, figures like Nick Newman and Jack Ringwald imparted invaluable lessons, fostering disciplined underwriting and innovative warehousing techniques. Later in life, Warren associated with luminaries such as Katharine Graham and Bill Gates, drawing inspiration from their achievements. These relationships proved fruitful, providing Warren with visionary business role models. The lesson is clear. Aspire to associate with greatness, and you'll ascend to new heights. Conversely, aligning with mediocrity may lead to unforeseeable depths. Aim high in your associations, and the summit awaits. Aim low, and the abyss beckons. Chapter 29, Harnessing Your Power Against Inflation. In the realm of inflation management, your most valuable asset is your own earning capacity. Warren Buffett famously extols the virtue of investing in oneself, asserting that enhancing your skills and expertise translates directly into tangible purchasing power. Whether you're a professional athlete or an efficient assistant, your primary asset is yourself. Buffett suggests viewing oneself through the lens of a business entity. Despite not resembling or behaving like a traditional business, you possess boundless potential for generating income with continuous room for growth. During the early stages of your journey, your earning potential might seem limited. However, with each stride in education and accumulation of experience, your capacity to earn expands exponentially. Education and experience serve as the twin pillars for establishing and fortifying your personal enterprise. Regardless of your chosen path, whether in accounting or music, everyone starts from humble beginnings and progresses through dedication and perseverance. While familial connections might provide initial opportunities, sustained success necessitates unwavering dedication and ambition in honing your craft. Buffett advocates for nurturing your personal enterprise by prioritizing both physical health and educational pursuits. Safeguarding and enhancing your earning potential against potential setbacks is paramount. In the battle against inflation, nothing surpasses the potency of your earning capabilities. The more distinctive your skills, the greater your autonomy in setting prices. Professions characterized by uniqueness historically offer a hedge against inflation, as limited competition affords practitioners the leverage to command higher fees. The underlying principle is straightforward. Each individual represents an economic entity brimming with untapped earning potential. By prioritizing self-care and educational enrichment, one's economic prospects are boundless, capable not only of weathering inflationary pressures, but also of fostering substantial wealth accumulation. Chapter 30, Navigating Personal Borrowing. Steer clear of borrowing at exorbitant interest rates like 18% or 20%. It's a surefire way to financial ruin. Warren Buffett, the sage of investment, wisely advises against it. In today's consumer landscape, merchants have shifted from merely selling goods to financing their purchase, doubling their profits in the process. Instead of relying solely on markups, businesses now capitalize on lending money to consumers. Credit card companies, for instance, have long recognized the lucrative potential of extending credit, even for the smallest purchases, and then levying steep interest charges on unpaid balances. This transition has turned modern retail outlets into covert banks. They entice customers with enticing offers like zero down payment and deferred payments for 60 days, all in exchange for signing a loan agreement. However, Buffett cautions against falling into the debt trap. He advocates for a conservative approach, citing his own example of buying his first house for a modest $34,000 and driving an inexpensive car even after achieving millionaire status. Buffett's philosophy is simple: live within your means, avoid unnecessary debt, and prioritize savings and investments. While others succumb to the allure of flashy possessions financed by debt, Buffett emphasizes the wisdom of the tortoise over the hare. The tortoise, representing the frugal investor, steadily accumulates wealth by living below their means and investing wisely, while the hare, driven by instant gratification and excessive borrowing, faces eventual financial ruin. In essence, borrowing less and saving more leads to financial security and peace of mind, whereas excessive borrowing and insufficient saving pave the way for instability and hardship. So heed Buffett's advice: embrace prudence, prioritize financial stability, and tread cautiously when it comes to borrowing. Thank you for joining us on this insightful journey into Warren Buffett's management secrets. Your interest in his investment methods is commendable, and we would like to recommend our other 5 books that delve deeper into his strategies. 1. Buffettology. 2. The Buffettology Workbook. 3. The New Buffettology. 4. The Tao of Warren Buffett. 5. Warren Buffett and the Interpretation of Financial Statements. We appreciate your support and hope you found this audiobook enriching.